There are close to 90 companies on the Dividend Aristocrat list, but how do you know which ones will actually give you the best returns? Sure, many of these companies have been paying dividends for decades, but not all of them are as good as they seem. Some are underperforming and barely move the needle for your portfolio. Others may look good on paper, but aren't built for today's market. So how do you separate the winners from the losers? In this video, I'm ranking every Dividend Aristocrat from worst to best, breaking them down by dividend yield, growth, and overall investment potential. I'll show you and John the underperformers, steady dividend stocks, dividend growth with high appreciation, and in the end, I'll show you high-growth aristocrats that on average increased their share prices by over 20% each year for the last decade. Now, before we get into the rankings, let me quickly walk you through how this video is set up. You've probably heard the term Dividend Aristocrat before. These are companies that have a proven track record of not only paying dividends consistently, but also increasing them year after year for at least 25 consecutive years. But here's the thing, not all Dividend Aristocrats are the same. While many of these companies are known for their reliability and steady income, others have experienced impressive share price growth over the past decade. To give you a clearer picture, I've grouped all the Dividend Aristocrats into categories based on two key factors: dividend yield and 10-year share price growth. Some of these companies are perfect if you're looking for a solid income stream, while others have the potential for explosive growth, and some not so much in either of those categories. Here's a breakdown of how this video will unfold. We'll start with the underperformers, stocks with a dividend yield of less than 4% and weak or negative share price growth. While these companies have struggled over the past decade, they still offer insights into what to avoid in the market. Next, we'll look at stocks that offer 2% to 4% dividend yields with modest share price growth, 2% to 5% over the last 10 years. These stocks provide steady income, but their share price growth isn't explosive. They might be more suited for conservative investors. In the moderate performers category, we'll examine stocks with 2% to 3% dividends and 5% to 10% share appreciation. These companies have shown consistent performance over time, providing a middle ground option for investors seeking both income and growth. Then we'll move to stable growth with modest yield stocks, those with 1% to 2% dividend yields and 5% to 10% share price appreciation. These companies have a solid track record of growth and stability, making them appealing to long-term investors who value reliability. Then there's the stable income category, focusing on stocks offering 3% or higher dividends and consistent growth of 2 to 5% annually. For those seeking high dividends but are willing to accept minimal or negative share price growth, we'll discuss high-yield, low-growth stocks. These companies offer returns primarily through dividends, less than 4%, but their share prices have remained stagnant or even declined. Next, I'll show you the dividend growth with high appreciation category, companies offering 2% to 3% dividend yields with over 10% share price growth in the past decade. These stocks combine both steady dividend growth and impressive share price appreciation, making them ideal for investors who want a mix of income and capital gains. Finally, we'll rank the high growth category, where you'll see stocks with less than 2% dividend yields but exceptional share price growth, 10 to 20% and more. These companies are at the forefront of innovation, and their rapid growth makes them perfect for investors looking for explosive returns and willing to sacrifice dividends for higher potential gains. Throughout this video, I'll highlight some standout companies from each category, discuss their strengths, and show you why these stocks have been outperforming their peers. By the end, you'll have a clear idea of which Dividend Aristocrats deserve a spot in your portfolio. So let's start with the first category, which is the underperformers. These are companies that offer a dividend yield below 4%, but over the past 10 years, their share price growth has either been under 2% or even negative. Now, it might sound like a good deal to get these stocks for their long history of dividend payments, but the truth is that their slow or sometimes shrinking growth could end up hurting your portfolio over time. Sure, you'll be getting those steady dividend payments, but when the stock price isn't growing, it means your investment isn't doing much to build wealth. One company that falls into this category is Wiley, along with its sibling stock Wiley B. Both of these offer a 3.44% dividend yield and have been increasing their dividends for 26 consecutive years. Sounds pretty good, right? But here's the catch. Over the past decade, Wiley's share price on average each year dropped by 4.16%. And Wiley B didn't do any better, with a 4.14% yearly drop. So while you're collecting a steady dividend, the company's value is eroding. This makes it tough for your overall portfolio to grow. So unless you're only focused on dividends and don't care about capital appreciation, Wiley might not be the best pick for you. Next up is Stanley Black & Decker, a name you probably recognize in the tools and home improvement industry. This company has been growing its dividend for 56 years straight, which is incredibly impressive. With a dividend yield of 3.72%, it seems like a solid income stock on paper. But here's the issue. Over the last 10 years, its share price has actually dropped by an average of 0.91% each year. For a company that's in an industry where demand is usually pretty steady, this lack of growth is concerning. While the dividend is nice, the lack of share price growth means your overall investment isn't keeping up with inflation, let alone growing. Stanley Black & Decker might be reliable when it comes to tools, but as an investment, it's falling short. Now, you'd expect a big name like ExxonMobil to be a strong performer, but it actually lands in the underperformers category as well. Exxon has a 3.71% dividend yield and has been growing its dividends for 42 years. But despite its size and history, the company's share price has only grown by an average of 1.48% over the last decade. This slow growth is surprising considering the global demand for energy. However, Exxon has faced challenges with fluctuating oil prices and increasing pressure to move toward renewable energy. While the dividend is attractive, the sluggish share price growth might make you think twice before adding Exxon to your portfolio. Another disappointing performer is Matthews International Corporation. It has a 3.57% dividend yield and has grown its dividends for 26 years, but the share price tells a different story. Over the past 10 years, Matthews stock has dropped by 5.27% on average each year. That's a significant decline, especially for a company that's supposed to be a dividend aristocrat. The company operates in industries like memorialization and industrial technologies, which don't always offer the same growth opportunities as other sectors. While the dividends are consistent, the declining stock value would eat into your overall returns, making Matthews a risky pick for long-term investors. Next up in the underperformer category is Genuine Parts Company, a company known for auto parts and industrial products. It offers a 3.44% dividend yield and has an incredible 68-year streak of dividend growth. But despite this long history, the company's share price has only grown 1.73% on average each year over the past 10 years. While Genuine Parts provides steady income, its lack of share appreciation limits its appeal for investors who want their portfolios to grow over time. It's a good option if you're focused solely on dividends, but don't expect your investment to multiply anytime soon. Kimberly-Clark, the company behind household names like Kleenex and Huggies, falls into the same boat. It has a solid 3.88% dividend yield and 52 years of dividend growth, but its share price has only grown 1.67% on average over the past 10 years. In an industry where many of its products are staples, this slow growth is surprising. While the dividends are reliable, the stock isn't really helping your investment grow. Hormel Foods is another company that has a decent dividend yield of 3.87% and has increased its dividends for 58 years, but similar to others in this category, its share price has only increased by 1.38% over the past decade. Hormel's focus on stable but slow-growing markets could be why its stock price hasn't performed better. Again, you get the dividends, but the lack of growth could leave your portfolio stagnating. And then there's Archer Daniels Midland, a leader in food processing and commodities, offering a 3.9% dividend yield and a 49-year streak of dividend growth. But despite its strong position in the market, its share price has only grown by 0.5% over the last decade. It's another example of a reliable dividend payer that struggles to provide any significant growth. Finally, we have National Fuel Gas, West America Bank Corporation, and PPG Industries. These companies operate in different industries, energy, banking, and industrial coatings, but they share the same issue: poor share price growth. National Fuel Gas has a 2.94% yield, but has only grown 0.63% over 10 years. West America offers a 3.43% yield, but has only grown 1.88%. PPG, meanwhile, despite its long history, has only managed a 0.17% increase in share price. These numbers show that even companies with solid dividends can struggle to grow their stock prices. While they might be reliable income sources, they won't help much if you're looking to build long-term wealth. So what's the takeaway here? The underperformers might offer steady dividends, but their lack of growth makes them less attractive for long-term investors. If you're looking for consistent income and don't care about capital appreciation, well then these stocks might just have a place in your portfolio. But if you want your investments to grow and build wealth over time, you might be better off looking at other categories with stronger growth potential. So don't worry if these dividend aristocrats have disappointed you. The next categories have companies that offer a better balance of dividend income and growth, giving you the best of both worlds. And that brings us to our next category, which is low growth with moderate yield. After looking at the underperformers, which struggled with both dividend yields and share growth, we now move to a slightly better group, the low growth with moderate yield stocks. These companies offer dividend yields between 2 and 4%, which is decent for generating steady income. However, their 10-year share price appreciation is between 2% and 5%, meaning their stock prices aren't growing very quickly. But they are better than the last category. First up in this category is Bank OZK. With a dividend yield of 3.31%, Bank OZK has been increasing its dividends for 27 years. However, its average share appreciation sits at just 4.18%. Now, this isn't terrible, but it's not enough to make your investment grow significantly over time. The banking sector can be stable, but it also faces a lot of regulations and is influenced by interest rates, which can slow down growth. Banks are great if you want consistent dividend income, but if you're looking for exciting growth, they might feel a bit too predictable. Next, we have Colgate-Palmolive, a household name that's been growing its dividends for 61 years. While the company offers a 2.31% dividend yield, its share price has only appreciated by 2.28% on average each year over the past decade. So why isn't Colgate growing faster? Why is growth so slow for such a well-known company, right? Well, the answer lies in the mature nature of the consumer goods industry. People will always buy toothpaste and soap, but there's not much room for explosive growth in this sector. Colgate is reliable for steady income, but it won't do much to grow your portfolio quickly. Next is H.B. Fuller, a company that makes industrial adhesives and sealants. Fuller offers a 1.41% dividend yield and has been growing its dividends for 55 years. Its share price has grown 3.96% over the past decade, which is slightly better. Fuller operates in a niche market, which gives it some stability but also limits its growth potential. While the company is solid, it's not going to deliver the kind of big returns that faster-growing sectors like tech might offer. New Jersey Resources is another one in this category. It's an energy company that focuses on natural gas and clean energy solutions. It has a 3.75% dividend yield and has increased its dividends for 35 consecutive years. While that's a solid track record, NJR's share price has only grown an average of 3.8% over the past 10 years. The energy sector can be tricky because it's heavily influenced by market fluctuations and regulatory changes. New Jersey offers steady income, but its growth is tied to energy prices and environmental policies, which can slow things down. It's a safe, income-generating stock, but the growth side is more fluctuated. Next in this category is the York Water Company. It might not be a name you hear every day, but it's been paying dividends for a long time. It offers a 2.83% dividend yield and has been increasing its dividends for 31 years. Water utilities are known for being stable investments because people will always need water. However, this stability also means limited growth potential. York Water is a great choice if you want to invest in something safe and consistent, but it won't deliver huge returns. After all, over the past 10 years, it only has an average share price appreciation of 2.72%. Next, we have C.H. Robinson Worldwide, a logistics company that helps businesses manage transportation and supply chains. The company has a 2.49% dividend yield and has been growing its dividends for 27 consecutive years. The logistics industry can be a slow grower because it's tied to global trade and economic cycles. Robinson provides steady income, but its growth is tied to how well the economy is doing overall. It's a good pick if you want reliable dividends and don't mind slower growth. Next, we have Tennant Company, which makes cleaning equipment, things like floor scrubbers and sweepers. It offers a low 1.38% dividend yield, but has a solid 52 years of dividend growth. However, its stock has grown by an average of 2.44% over the past decade. Cleaning equipment might seem like a boring industry, and the slow growth reflects that. Tennant is a dependable choice if you're looking for low-risk income, but it's not the kind of stock you'll buy for rapid appreciation. Tompkins Financial Corporation is another regional bank that offers a 3.54% dividend yield and has increased dividends for 27 consecutive years. Its share price, on average, has grown 2.87% over the last decade. Regional banks like Tompkins can be stable, especially since they focus on serving local markets. But their growth tends to be slow and predictable, meaning if you want more than just steady dividends, you might be better off looking at other stocks with stronger growth potential. The last stock in the low growth and moderate yield category is Stepan Company. This is a niche manufacturer in the specialty chemicals industry, producing things like surfactants for cleaning products, agricultural additives, and polymer polyols for insulation materials. This diversified product portfolio provides stable revenues but limited growth, and indeed the company's stock price has seen only slow appreciation, recently hovering near 52-week lows with relatively low volatility at the time those lows were recorded. However, Stepan compensates for its modest growth with very steady dividends. 2025 marked its 57th consecutive year of annual dividend increases. This long-running commitment to shareholder payouts gives Stepan a modern dividend yield of around 2.5%, helping you earn a reasonable return even when the stock's price gains are subdued. The low growth with moderate yield group offers consistent dividends and slow, steady growth. These stocks are great for investors who want to generate income while minimizing risk. However, if you're looking to build wealth quickly, these companies might feel a bit too slow for your liking. But don't worry, because later on, as we move up the tier list, there are better options to come. I'll show you stocks opposite to this category, which have high dividend growth and high stock appreciation. And at the end, I'll show you high growth stocks that on average have increased their share prices by over 20% each year for the last decade. Now that we've gone through underperformers and the low growth with moderate yield groups, it's time to look at a more promising set of stocks, the moderate performers. These are companies that offer a dividend yield between 2 and 3%, while their 10-year average annualized share appreciation ranges from 5 to 10%. This makes them appealing to investors who want both steady income and respectable growth. Think of moderate performers as the middle ground. They won't skyrocket like high-growth tech stocks, but they won't move at a snail's pace either, like some of the companies we've already covered. These stocks are great for building a portfolio that grows over time while still giving you consistent dividends to reinvest or spend. So let's take a closer look at the companies in this category and see why they might be the perfect fit for your investment strategy. First up in the moderate performers is the community bank system with the ticker CBU. It offers a 2.1% dividend yield and has been increasing its dividends for 32 consecutive years. Over the past 10 years, its share price on average has grown by 6.39%. Community banks like CBU tend to have a strong connection to their local markets, which makes them stay stable even when larger banks face challenges. CBU has managed to grow steadily while keeping shareholders happy with consistent dividends. It's not going to deliver massive returns, but it provides a nice balance of growth and income, ideal for investors who like to play it safe but still want their money to grow. Next is IBM, a true giant in the tech industry that's been around for over a century. IBM offers a 2.61% dividend yield and has been growing its dividends for 35 consecutive years. Over the past decade, IBM's share price has grown by 5.38%. IBM is a bit unique because it operates in technology, an industry known for rapid growth, yet it moves at a slower pace compared to other tech giants like Microsoft or Apple. The company has been shifting its focus from hardware to cloud computing and AI, which has helped boost its growth in recent years. While it may not deliver the explosive gains of newer tech companies, IBM does provide a steady income stream and moderate growth, making it a good choice for tech-savvy investors looking for a less volatile option. Water is one of the most essential resources on the planet, and California Water Service Group with the ticker CWT knows how to capitalize on that. CWT offers a 2.65% dividend yield and has been increasing its dividends for an impressive 57 consecutive years. Over the past 10 years on average, its share price has grown by a respectable 5.88%. Utilities like CWT are known for their stability. People will always need water, and this consistent demand helps keep the company's revenue stable. While the growth isn't explosive, the combination of steady dividends and modest share appreciation makes CWT a reliable option. Next, we have First Source Corporation and General Dynamics in this category. These two companies operate in very different industries, banking and defense, but they both fall into the moderate performers category. First Source Corporation offers a 2.3% dividend yield and has been growing its dividends for 37 consecutive years. Its share price has grown 8.23% over the past decade. As a regional bank, First Source Corporation provides stable income and benefits from local economic growth, making it a solid investment for those who prefer community-focused banks. On the other hand, General Dynamics offers a 2.21% dividend yield and has been increasing dividends for 33 years. Its share price has grown by an average of 6.34% over the past decade. General Dynamics is a major player in the defense and aerospace industry, benefiting from consistent government contracts and military spending. This stability makes it a good pick for investors looking for moderate growth and steady income from a company that plays a key role in national defense. Old Republic International Corporation is another solid player in the moderate performers category. This insurance company offers a 2.9% dividend yield and has been increasing dividends for 43 years. Over the past 10 years, its share price on average has grown by 9.65%, making it one of the higher performers in this group. Insurance companies like Old Republic tend to have predictable revenue streams, which makes them a great option for income-seeking investors. The fact that ORI has managed to deliver strong share price growth alongside reliable dividends makes it an attractive pick for those looking for both stability and growth. Another water utility in this category is American States Water Company, with the ticker AWR. It offers a 2.5% dividend yield and has been increasing its dividends for an incredible 69 consecutive years, one of the longest streaks among dividend aristocrats. Its share price has grown 6.25% over the past 10 years. Like CWT, AWR benefits from the consistent demand for water services. The company has a monopoly in certain regions, which helps it maintain stable profits. The combination of decades-long dividend growth and steady share price appreciation makes AWR a rock-solid investment for this category. Next up, we have MGE Energy and McCormick & Company. Both are well-established companies with consistent performance, but they operate in very different industries, utilities, and food products. MGE offers a 2% dividend yield and has been increasing its dividends for 48 consecutive years. Its share price has grown by an average of 6.69% over the past decade. As a utility company, MGE benefits from the essential nature of its services, providing steady income and modest growth. On the other hand, McCormick & Company, known for its spices and seasonings, offers a 2.33% dividend yield and has been growing dividends for 99 consecutive years, almost a full century. Its share price, on average, has grown 7.72% over the past 10 years. McCormick benefits from the global demand for its products and the company's strong brand recognition. While it operates in a mature industry, McCormick's steady growth and reliable dividends make it a great pick for conservative investors. No list of dividend aristocrats would be complete without mentioning Procter & Gamble with the ticker symbol PG. PG offers a 2.43% dividend yield and has been increasing its dividends for 68 consecutive years. Over the past decade, its share price on average has grown 6.8%. PG is a consumer goods giant, with products ranging from laundry detergents to baby care items. Its wide range of well-known brands like Tide, Pampers, and Gillette makes PG a household name and a stable investment. While its growth isn't explosive, the combination of consistent income and steady share price appreciation makes PG a favorite for investors looking for reliability. Next, we have Lancaster Colony Corporation and Cullen/Frost Bankers. LANC offers a 2.25% dividend yield and has been increasing its dividends for 61 consecutive years. Its share price has grown by an average of 6.33% over the past 10 years. Lancaster Colony is known for producing specialty foods, including the famous Marzetti salad dressings. The company operates in a niche market, which helps it maintain consistent revenue and dividend growth. Frost Bankers, on the other hand, offers a 2.73% dividend yield and has been growing its dividends for 30 years. On average, its share price has grown 7.52% over the past decade. As a regional bank in Texas, Frost Bankers benefits from the state's strong economy and growing population. This has helped the bank maintain steady growth while offering a solid dividend. Lastly, we have Atmos Energy, a fully regulated natural gas utility serving millions of customers across several states, which gives it a stable and reliable business foundation. The company has a decades-long track record of steady dividend growth. It has increased its dividend every year since the early 1980s, earning Atmos the status of Dividend Aristocrat. It has a current dividend yield of 2.44%. As for the share price growth, it increases on average 9.42% every year, making it one of the best in this category. So the Moderate Performers Group is perfect for those who want to build a portfolio that grows steadily over time without taking on too much risk. These stocks won't deliver the rapid gains of high-growth stocks, but they provide reliable dividends and consistent share price appreciation. If you're looking for a mix of income and growth without the roller coaster ride, these stocks are a great choice. However, if you're ready to explore even more growth potential, the next category is where things really start to get exciting. Stable growth with modest yield. Companies in this category offer dividend yields between 1% and 2%, which might seem low at first, but don't let that fool you. Their 10-year share appreciation sits on the higher side of the 5 to 10% range, which means they're quietly growing in the background while still rewarding shareholders with consistent dividends. Think of these stocks as steady achievers. They might not grab headlines with flashy dividend payouts, but they steadily build wealth over time. If you're an investor looking for long-term growth with a side of reliable dividends, this category might be perfect for you. These companies are great for people who don't need immediate income but want their investments to grow steadily while providing some passive income. So let's look into the companies that make up this category and see what makes them stand out. First up is Aptar Group. This company offers a 1.15% dividend yield and has been growing its dividends for 31 consecutive years. Over the past decade, ATR's share price on average has increased by 9.49%, which is impressive for a company with such a modest dividend. Aptar Group specializes in dispensing systems, things like the pumps on your lotion bottles, spray tops on perfumes, and packaging for pharmaceuticals. While this might not sound glamorous, Aptar Group plays a vital role in industries like healthcare, beauty, and food packaging. Because its products are in constant demand, the company has enjoyed stable growth and consistent revenue. While the dividend isn't huge, the company's steady growth makes it a solid pick for investors looking to grow their wealth over time. Next up is Ecolab, a leader in water, hygiene, and energy technologies. Ecolab offers a 1.04% dividend yield and has been increasing dividends for 32 consecutive years. Its share price has grown 8.96% over the past 10 years. Ecolab helps businesses keep their operations clean and efficient, from restaurants and hospitals to industrial plants. In a world where sanitation and sustainability are becoming more and more important, Ecolab's services are always in demand. The company's focus on environmentally friendly solutions gives it a competitive edge in a growing market. While its dividend yield is on the smaller side, the company's share price on average has grown by 8.96% every year over the past decade. Investors who are looking for consistent, reliable growth while still getting some dividends will find Ecolab an attractive pick. Next up, let's take a look at Raytheon Technologies Corporation and Albemarle Corporation. These two companies operate in very different industries: defense and aerospace for Raytheon and specialty chemicals for Albemarle, but they both fit into the stable growth with modest yield category. Raytheon offers a 1.95% dividend yield and has been growing its dividends for 35 consecutive years. Its share price has grown by an average of 5.63% over the past 10 years. Raytheon is a major player in the defense industry, providing aerospace solutions and military technology to governments around the world. While the industry can be volatile due to political factors, Raytheon's diverse portfolio helps keep it steady. On the other hand, Albemarle Corporation offers a 1.92% dividend yield and has been growing its dividends for 30 years. It has an average share price appreciation of 5.48%. Albemarle is one of the world's largest producers of lithium, which is essential for electric vehicle batteries and renewable energy storage. As the world continues to move toward clean energy, Albemarle stands to benefit from long-term growth. Both companies offer modest dividends, but their potential for future growth makes them attractive for those who are thinking about the big picture. Donaldson Company is another strong performer in this category. Donaldson offers a 1.52% dividend yield and has been increasing its dividends for 37 consecutive years. Over the past 10 years, its share price has grown by an average of 6.62%. Donaldson specializes in filtration systems for everything from industrial machinery to automobiles. Clean air and efficient filtration are essential in today's industries, and Donaldson's products help companies maintain their equipment and reduce environmental impact. The company's focus on innovation and sustainability has helped it grow steadily over time. Becton Dickinson and Company, commonly known as BD, is a medical technology company that offers a 1.68% dividend yield and has been increasing its dividends for 52 consecutive years. BD is known for its medical devices such as syringes, infusion systems, and diagnostic equipment. The healthcare sector is always in demand, and BD's products are used in hospitals, clinics, and research labs around the world. The company's commitment to innovation and improving patient care has helped it maintain steady growth. Over the past decade, BD's share price has grown by an average of 6.04%. Next, we have Emerson Electric, a global technology and engineering company that offers a 1.62% dividend yield and has been increasing its dividends for 28 consecutive years. The business provides automation solutions and commercial technologies for industries like energy, manufacturing, and healthcare. The company's focus on innovation and efficiency has helped it grow steadily, even during challenging economic times. The stock's average annual share price sits around 8.14%. Emerson's diversified portfolio makes it a resilient choice for investors who want a mix of stability and growth. Last but not least is Expeditors International of Washington. Expeditors offers a 1.29% dividend yield and has been increasing its dividends for 31 consecutive years. EXPD is a global logistics company that helps businesses manage their supply chains and freight transportation. As the world becomes more connected and global trade continues to grow, companies like EXPD are in high demand. And that's why, over the past decade, it's had an average share price growth of 9.87%, which is one of the highest in this category. The company's ability to adapt to changing markets and economic challenges has helped it achieve strong growth while still paying reliable dividends. So, the stable growth with modest yield group is perfect for investors who want to grow their wealth steadily while still receiving reliable dividend income. These companies might not offer the highest dividends, but their consistent performance and steady share price appreciation make them solid long-term investments. Up next, I'll show you the category Stable Income, where we'll look at stocks that focus more on income generation without compromising on stability. Later on, as we move up the tier list, I'll show you stocks that offer both high dividend growth and high stock appreciation. And at the end, I'll show you high growth stocks that, on average, have increased their share prices by over 20% each year for the past decade. But first, let's look into the stable income category. These companies offer dividend yields of 3% or more, which means they provide a consistent cash flow. However, their 10-year share price appreciation is a bit slower, generally between 2 and 5%, but not negative. While they won't make your portfolio skyrocket overnight, these companies provide an excellent foundation for long-term income stability. So let's take a closer look at these income-generating champions and see what makes them stand out. First up is Chevron Corporation, one of the biggest names in the energy sector. Chevron offers a generous 4.58% dividend yield and has been growing its dividends for 37 consecutive years. Chevron's business focuses on oil and natural gas, which can be a double-edged sword. When oil prices are high, the company thrives, but when prices fall, growth can slow down. However, Chevron has managed to maintain steady dividends through all kinds of market conditions thanks to its global operations and diversified energy portfolio. As for its stock growth, over the past decade, it has managed an average share price growth of 3.14%. Next, we have two relatively smaller companies that offer stable dividends: Artesian Resources Corporation and Arrow Financial Corporation. Artesian offers a 3.89% dividend yield and has been increasing its dividends for 30 consecutive years. On average, its share price has grown 3.2% each year over the past decade. Artesian is a water utility company, which means it provides an essential service that people can't live without. This makes it a defensive stock, one that performs well even during tough economic times. Similarly, Arrow offers a 4.21% dividend yield and has also grown its dividends for 30 years. It has a share price growth rate of 2.51%. Arrow Financial is a regional bank that focuses on providing banking services in its local communities. While banks can be sensitive to interest rates and economic downturns, regional banks like Arrow tend to be more stable because of their close ties to their local communities. Both of these companies offer consistent income with modest growth, making them great options for investors who prioritize reliable dividends. When it comes to household names in investing, Johnson & Johnson is always at the top of the list, and it also gets its spot in the stable category. J&J is a healthcare giant, producing everything from medical devices and pharmaceuticals to consumer health products like Band-Aids and baby shampoo. The stock offers a 3.26% dividend yield and has been increasing its dividends for an incredible 62 consecutive years. Its share price has grown 4.03% on average each year. With its combination of reliable dividends and steady growth, J&J is perfect for investors who want stability in their portfolios while still seeing modest capital appreciation. This category holds two more water utility companies, Essential Utilities and SJW Group. Essential Utilities offers a 3.67% dividend yield, has been growing its dividends for 31 consecutive years, and has an average share price appreciation of 2.52% over the last 10 years. Similarly, SJW offers a 3.34% dividend yield and has increased its dividends for 57 consecutive years. It offers an average share price appreciation of 3.77%. Water utilities tend to be low-risk investments because demand for water is constant. While the share price growth isn't impressive, these companies offer consistent dividends that make them great for investors looking for steady income without a lot of volatility. Next, we have two of the biggest names in the beverage industry, PepsiCo and the Coca-Cola Company. These companies have been battling for the top spot in the soft drink market for decades, and they're both fantastic choices for income-focused investors. PepsiCo offers a 3.6% dividend yield and has been increasing its dividends for 52 consecutive years. It has an average share price appreciation of 4.59%. While Pepsi is known for its soft drinks, the company also has a strong presence in the snack food market with brands like Lay's and Doritos, which helps diversify its revenue. Coca-Cola, meanwhile, offers a 3.06% dividend yield and has been growing its dividends for 62 years. Its share price has appreciated 4.31% on average over the past 10 years. Both companies offer solid dividend income and slow but consistent growth. They're great picks for investors who want to invest in well-established brands that continue to perform year after year. Next, we have T. Rowe Price Group and Consolidated Edison. These companies are in different industries, investment management and utilities, but they both offer stable income and steady growth. Rowe offers a 4.24% dividend yield and has been increasing its dividends for 38 consecutive years. T. Rowe Price is a financial services company that manages investments for individuals and institutions. The company benefits from a steady income and a reputation for strong financial management. As for its stock growth, it has maintained an average 3.71% stock growth over the past decade. Consolidated Edison offers a 3.63% dividend yield and has been growing its dividends for 50 years. It has a share price of 3.11%. As a utility company, Edison provides essential energy services to millions of people in the New York City area. The Clorox Company and Universal Corporation are two more companies that offer a stable income. Clorox offers a 3.08% dividend yield and has been increasing its dividends for 47 consecutive years. Clorox is known for its cleaning products, which definitely saw a spike in demand during the COVID-19 pandemic. While the company's growth has slowed since then, it remains a reliable dividend payer. Over the past decade, it has averaged a share price appreciation of 3.95% each year. Universal, on the other hand, offers a 6.1% dividend yield, the highest in this group, and has been growing its dividends for 53 years. However, its share price has only averaged 2.25% over the last decade. Universal Corporation is involved in the tobacco industry, which faces challenges due to regulations and declining smoking rates. Last but not least is Target Corporation, one of the most popular retailers in the United States. Target offers a 3.25% dividend yield and has been increasing its dividends for 56 consecutive years. Target has done an excellent job of adapting to changing shopping habits, investing in e-commerce and store renovations to stay competitive. This can also be seen from its average share price growth of 6.16%, which is also one of the highest in this category. The company's ability to balance growth with reliable dividends makes it a standout in the stable income category. So, the stable income group is perfect for investors who want to generate consistent cash flow from their investments without worrying about the ups and downs of the stock market. These companies may not offer explosive growth, but their reliable dividends and steady share appreciation make them ideal for long-term income-focused portfolios. Next, we'll look into the high-yield, low-growth category, where companies offer even higher yield potential but slower stock growth. In this category, companies offer dividend yields of 4% or more, which means they provide large, regular payouts to shareholders. These stocks are like cash cows. They give you big dividends regularly, but don't expect their stock prices to grow much. In fact, some of these companies have seen their stock prices decline over time. This makes them great for people who want immediate income, like retirees or those who rely on dividends to pay bills. They might not be the best choice for investors looking to grow their wealth through capital appreciation. Let's take a closer look at these high dividend payers and explore why their share prices might be struggling despite their generous payouts. Let's start with Sonoco Products Company. Sonoco is in the packaging industry, producing everything from consumer packaging to industrial containers. While packaging isn't always in demand, it's a competitive market with thin profit margins. This means the company doesn't have much room for explosive growth, but it can still generate steady cash flow to support its high dividends. The stock offers a 4.37% dividend yield, which is quite generous, and has been growing its dividends for 42 consecutive years. But when we look at its share price growth, it only goes up by 0.51% on average each year. Next, we have National Retail Properties and Black Hills Corporation. Both companies offer high yields. National Retail is a real estate investment trust, or REIT in short, that focuses on freestanding retail properties. While REITs are known for their high dividends, they can struggle with growth if the retail sector faces challenges like the rise of e-commerce. The stock offers a 5.89% dividend yield and has been increasing its dividends for 34 consecutive years. However, its share price has actually declined by 0.72% over the past decade. Now, Black Hills is a utility company that provides natural gas and electricity. Utilities are known for their stability, but they often face regulatory challenges that can limit growth. Still, it offers a 4.6% dividend yield and has been growing its dividends for 35 years. Next, both UGI Corporation and Northwest Natural Holding Company fall squarely into the high-yield, low-growth category, with each offering strong dividend payouts but underperforming in terms of capital appreciation. UGI provides natural gas and energy services, but the company has faced challenges with market volatility and rising costs. It offers a 4.88% dividend yield and has been increasing its dividends for 37 consecutive years. However, its share price has declined by 2.25% over the past decade. Like UGI, Northwest operates in the natural gas sector, which can be heavily impacted by fluctuating energy prices and regulatory changes. It offers a 4.91% dividend yield and has an impressive 68-year streak of dividend growth. Despite this, Northwest's share price has seen an average yearly decline of 2.42% over the past 10 years. Altria Group is one of the most well-known names in the tobacco industry of this category. It's the company behind Marlboro cigarettes, but the decline in smoking rates and increasing regulations on tobacco products have made growth difficult. Despite these challenges, Altria continues to generate strong cash flow, which it returns to shareholders in the form of high dividends. It offers a massive 7.81% dividend yield and has been growing its dividends for 55 consecutive years. For those looking for big dividend payouts, Altria is hard to beat, but the long-term future of the tobacco industry is uncertain, which makes this stock riskier than some of the others in this category. Next, we have Polaris, which operates in a cyclical industry, meaning its performance is closely tied to the economy. It's known for making off-road vehicles, snowmobiles, and motorcycles. When times are good, people are more likely to buy recreational vehicles, but during economic downturns, sales can plummet. This makes the company's revenue volatile, which explains the decline in its stock price. The stock offers a 5.62% dividend yield and has been growing its dividends for 28 consecutive years. While Polaris offers a high dividend yield, its poor share price performance that declines on average 10.59% makes it a risky investment for anyone looking for long-term growth. Last but not least is Enterprise Products Partners LP, with the ticker EPD, a major player in the energy infrastructure sector. It operates pipelines and storage facilities for natural gas and petroleum products. While the company generates steady cash flow from its infrastructure assets, the energy sector is highly sensitive to market fluctuations and regulatory risks. This can make it difficult for companies like EPD to achieve significant share price growth. The stock offers a 6.55% dividend yield and has been growing its dividends for 26 consecutive years. So the high-yield, low-growth category is perfect for those who want immediate income and aren't too concerned about capital appreciation. These companies offer generous dividends and have proven they can maintain payouts even during tough times. However, their slow or negative share price growth makes them less appealing for those looking to build wealth over time. However, if you're looking for a balance between dividend income and stock appreciation, the next category, dividend growth with high appreciation, is where you'll want to focus. And after that, I'll show you the high-growth stocks that on average have increased their share prices by over 20% each year for the last decade. But first, let's look into stocks that have dividend growth with high appreciation. Some companies give you two benefits at once. They pay you money for owning their stock, and their stock price also goes up over time. This balance of dividend income and stock price growth is why we call them dividend growth with high appreciation stocks. Let's take a look at some of the top companies in this category and why they stand out. Republic Bancorp is a regional bank that has built a strong reputation over the years. It's not as big as some of the major banks, but it has a solid track record. The company offers a 2.76% dividend yield, and its stock has grown by 10.72% over the last decade. Republic Bancorp has been increasing its dividend for 26 consecutive years, which is a great sign of stability. Despite being a smaller bank, Republic Bancorp has done a good job in managing its growth and staying steady during tough times. If you're looking for a reliable income source with steady growth, this bank is a great option to consider. The next stock in this category is Fastenal, a leading distributor of industrial supplies, tools, fasteners, and safety equipment, and it plays a key role in many growing industries. Fastenal offers a 2.35% forward dividend yield and has seen its share price appreciate by 12.33% on average. The company has been consistently increasing its dividends for 32 years. It has established a strong customer base in the industrial sector, and as industries continue to expand, so does the demand for Fastenal's products. While its dividend yield isn't the highest, its solid stock price growth and dependable income make it a great pick for those who want a mix of both. Next, we have ADP, a massive player in payroll and human resources services, helping businesses around the world manage their payroll, benefits, and compliance. The company offers a 2.03% forward dividend yield and has seen a solid 13.54% share price appreciation on average. The stock has been growing its dividend for 49 consecutive years, which is a huge mark of consistency and stability. With new technology making their services even more efficient, ADP stands to keep growing, making it an excellent choice for long-term investors looking for both reliable dividends and stock price appreciation. NextEra Energy is another stock that rocks this category. It's a leader in renewable energy, focusing heavily on wind and solar power. It's an exciting option for investors looking for environmentally conscious companies that also provide strong financial returns. The stock offers a 2.88% forward dividend yield and has enjoyed an annualized 10.01% increase in share price over the past decade. The company has been increasing its dividends for 35 years, making it a reliable choice for dividend-seeking investors. As global demand for clean energy rises, and with governments pushing for cleaner energy, NextEra is expected to keep growing while continuing to pay investors well. Next in this category is Illinois Tool Works, a diversified industrial company that makes products for various industries, from automotive to food processing. With a 2.32% forward dividend yield and 10.46% stock price annualized growth, ITW has shown strong, consistent performance. It's been increasing its dividend for 49 consecutive years. ITW's wide range of industries and consistent innovation have allowed it to grow even when certain sectors slow down. Our next favorite stock in this category is Cincinnati Financial. It's one of the longest-running insurance companies in the market, offering solid returns through smart risk management. It's been able to navigate the ups and downs of the market and remain profitable in the insurance industry, which has made it a favorite for income-focused investors. With its solid performance, even during economic downturns, Cincinnati Financial is an ideal stock for investors looking for reliable income and steady stock price appreciation over the long term. It offers a 2.36% forward dividend yield and has an average 10.15% stock price growth each year. The company has been growing its dividend for 64 consecutive years, making it a standout in terms of consistency. And lastly, rounding out the list of dividend growth with high appreciation category is Aflac, a household name thanks to its mascot, the duck, but it's also known for its strong financial performance in the insurance space. Aflac's business model has proven stable even during economic slowdowns, and its supplemental insurance products continue to see demand. Aflac offers a 2.16% forward dividend yield and has seen 13.77% stock price growth on average over the last 10 years. It has increased its dividend for 42 consecutive years, a strong indicator of its reliability and commitment to shareholders. If you're seeking both a solid income stream and growth potential, Aflac delivers both with its reliable dividend and steadily increasing stock price. Okay, so while the dividend growth with high appreciation category offers a balance of steady income and rising stock prices, some investors are willing to take on more risk for even greater rewards. That's where the high growth category comes in. These companies may not have the highest dividend payouts, but they make up for it with rapid share appreciation. They're often leaders in innovative industries, constantly expanding and reinvesting profits to fuel future growth. If you're looking for stocks with the potential to skyrocket, this next group is for you, the High Growth Group. These are the companies that may not offer big dividend payouts. In fact, they may have dividend yields below 2%, but they more than make up for it with explosive share price appreciation. All of the companies in this category have seen their share prices grow by over 10% to even 20% or more each year in the past decade. High-growth stocks are perfect for investors looking to supercharge their portfolios. While the dividends are modest and sometimes barely noticeable, these companies are innovating, expanding, and dominating their markets. If you're in the market for capital gains and are less focused on immediate income, this category is where you'll find your next big opportunity. Let's take a closer look at these high-growth stars and see how they've been outperforming the market. Kicking off this category are Franklin Electric and Brady Corporation. These companies may not be household names, but their performance speaks volumes. Franklin offers a 1.06% dividend yield and has been growing its dividends for 30 years. Franklin Electric specializes in pumping systems and fluid management technologies. With the growing demand for clean water and efficient energy use, Franklin Electric is positioned to keep expanding. Over the past decade, its share price has increased by an average of 10.87% each year. Brady, on the other hand, offers a 1.29% dividend yield and has been growing its dividends for 38 years. Brady Corporation focuses on workplace safety products and identification solutions. Think of labels, signage, and safety systems used in industries worldwide. Its average share price growth has also been consistently over 10% over the last 10 years. Both Franklin and Brady offer steady, modest dividends, but their real value comes from long-term growth potential in industries that are essential to the global economy. Next is Walmart. It offers a 0.85% dividend yield and has been increasing its dividends for 51 consecutive years. Its share price has grown by 13.07% over the past decade. Walmart continues to dominate the retail sector, adapting to changing consumer behaviors with its focus on e-commerce and logistics. The company's ability to balance low prices with operational efficiency has made it a consistent winner in the stock market. The next two stocks in this category belong to the home improvement sector: Lowe's Companies and Sherwin-Williams Company. Lowe's has benefited from the booming housing market and the rise in DIY home projects. The company's focus on e-commerce and store optimization has helped drive both revenue and profit growth. Lowe's offers a 1.77% dividend yield and has been growing its dividends for 61 years. As for its average share price growth, it has recorded a solid 14.08% annualized return over the past 10 years. Sherwin-Williams, meanwhile, offers a 0.8% dividend yield and has been increasing its dividends for 46 years. Its share price has appreciated an average of 14.66% each year over the past 10 years. Sherwin-Williams is a leader in paint and coatings, serving both residential and commercial markets. Both Lowe's and Sherwin-Williams combine solid business models with strong growth potential, making them excellent picks for long-term investors. Next, we have Casey's General Stores and Roper Technologies, two very different companies that share one thing in common: impressive growth. Casey's operates a chain of convenience stores in the Midwest, focusing on fuel sales, grocery items, and even freshly made pizza. The company's ability to cater to small-town markets and adapt to consumer needs has driven its growth. Casey's offers a 0.47% dividend yield and has been growing its dividends for 34 years. Its share price has averaged around 16.28% over the past decade. Roper, meanwhile, offers a 0.57% dividend yield and has been increasing its dividends for 27 years, and its share price has averaged around 13.68% over the past 10 years. Roper Technologies is a diversified company specializing in software and industrial technology. Its focus on high-margin businesses and recurring revenue streams has made it a consistent performer in the stock market. Next up, let's group together Grainger, Caterpillar, and Carlisle companies, three industrial giants that have shown impressive growth over the years. Grainger offers a 0.77% dividend yield with 15.82% average share price growth over the last decade. Caterpillar offers a 1.52% yield with 16.04% growth. And Carlisle offers a 1.03% yield with 15.57% growth. These companies operate in the industrial and manufacturing sectors, providing essential equipment and solutions for industries around the world. Next is Bank First Corporation, a regional bank that has built a solid reputation by focusing on strong relationships with local businesses and individuals. Unlike larger banks, Bank First stays connected to its community, offering tailored financial services that help its businesses grow steadily over time. This focus on local engagement and prudent lending strategies has allowed Bank First to maintain consistent growth both in stock price and services offered. With a 1.55% dividend yield and 31 consecutive years of dividend increases, Bank First has shown a solid commitment to rewarding its shareholders. Better than that, it has maintained an average share price appreciation of 14.91%. Then there is RPM International. It's a leader in the manufacturing of paints, coatings, and building materials used in residential and commercial markets. Over the years, RPM has established itself as a reliable company in a competitive industry, known for its ability to expand product lines and improve technology. It has a 1.61% dividend yield and 50 consecutive years of dividend growth. The company has also seen a 10.2% average yearly increase in stock price over the past decade. RPM reinvests a significant portion of its earnings back into its business, which has allowed it to maintain steady growth and a consistent dividend payout. The next stock in this category is Dover. It makes many kinds of machines and industrial equipment used in different industries, from energy to food packaging. It grows by creating new products and acquiring smaller companies, which helps it expand into new markets. Instead of paying big dividends, Dover reinvests in its business to improve its technology and production. This strategy has helped its stock price grow over time, rewarding investors with long-term gains. As a company with 68 consecutive years of dividend growth, it also provides a small but consistent payout, making it a well-balanced high-growth stock. The company has a 1.01% dividend yield, but most importantly, it has maintained an average stock price growth of 13.08% over the past decade. While its dividend yield may be lower than some other companies, its strong performance and focus on reinvestment into new technologies and markets make it an attractive long-term investment for those seeking both stability and growth. Our next stock is FactSet, a financial data and analytics company that helps businesses make better investment choices. It provides software and research tools used by banks, investors, and financial analysts. FactSet continues to grow by investing in better technology and expanding its services rather than paying large dividends to shareholders. This focus on innovation has helped its stock value grow steadily over time. With more companies relying on data to make decisions, FactSet's business is expected to stay strong and keep delivering long-term growth. The company has a low 0.88% dividend yield and has been growing its dividend for 25 consecutive years. Over the past decade, FactSet's stock price has grown by an average of 12.3% each year, reflecting its steady progress and the increasing demand for data-driven investment insights. Next in this category, we have Nucor, one of the largest steel producers in the United States, supplying materials for buildings, cars, and infrastructure. Instead of paying high dividends, Nucor reinvests in its business by building new factories and adopting modern steelmaking technologies. This investment helps the company lower costs, increase efficiency, and remain competitive in the industry. As the demand for steel continues to rise, Nucor is positioned to grow even more, making it a valuable long-term stock. Despite its focus on stock growth, which stands at an average 10.88%, Nucor still offers a good dividend yield of 1.71%, giving investors a mix of income and appreciation. West Pharmaceutical Services and S&P Global are two more examples of companies that have mastered both growth and dividends, but in very different ways. West Pharmaceutical provides packaging and delivery solutions for the healthcare industry, including injectable drug packaging. The company's success is tied to the pharmaceutical sector's growth and its focus on innovative healthcare solutions. West Pharmaceutical offers a tiny 0.25% dividend yield, but its share price growth has been massive, averaging 21.21% over the past decade. S&P Global, the parent company of Standard & Poor's, plays a crucial role in financial markets by providing credit ratings, market intelligence, and data analytics. As the global economy becomes more data-driven, S&P's importance continues to grow. It offers a 0.74% dividend yield and has been increasing dividends for 51 years. Its share price has averaged around 18.69% over the last 10 years. These two companies are perfect for investors who prioritize capital appreciation. While the dividends are minimal, the share price growth more than compensates for it. Want to know how to create a portfolio of the best dividend aristocrats combined with ETFs and REITs that pays over $6,000 in monthly dividend income with only a $20 a week investment? Click the video on the screen to find out how.